Good morning and welcome this morning to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab, and I am joined out there in the chat by my good friend John McNichol. I'm glad to have John back in here and glad to see that we've got John back and up and running the chats and participating. And John's been away for a while, and so we're glad to have John back. So he's going to be there. He's a 20-plus year veteran of the financial markets, well-versed in all of these ideas and concepts, and can teach all of this stuff. So I'm glad to have him there. And for my part, and for John as well, thank you all for being here. We're grateful to have you here as attendees in this particular webcast, whether you're watching in the recorded version or whether you're right here and live with us right now. And make sure that you participate in the conversation. John's there to help answer those questions along the way. So a couple of quick ideas that I wanted to talk about today, and a couple of requests. Number one, and this is only the second or third time that this has happened as we've been doing this in our 14-day to expiration, 7-day to expiration evolution of our short call or short vertical spreads on the indexes, specifically on the SPX. We had kind of a rip your face off rally that kind of overwhelmed our spread, and that's gonna happen, and we've had it happen a couple of times, and so we'll talk about that. We'll talk about what we might do to kind of flip the script a little bit with that. Second, I wanted to take a look at a question that somebody brought in to the comments, and that was discussing a 0 days till expiration on the short end calendar spread on the Russell 2000, and we'll take a look at that and some considerations there. And then I wanted to talk a little bit about hedging and when it might be the time to take the hedge off if we've got an index hedge running. So we'll talk a little bit about those things, see what's going on in the market. A couple of quick housekeeping items, though, as we get started in this discussion. Remember that everything we talk about is simply for illustrative and educational purposes only. It is not a recommendation. It is not any kind of advice. Remember that equity and index options carry a high level of risk. They are not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Remember that multiple leg option strategy will involve multiple transaction costs. Also, in most cases, spread trading requires a margin account. Now, one of the characteristics of options is that short options can be assigned and sometimes early. If they're American style options, they can be assigned early. If they're index options that are European style, then that early assignment risk is taken away, but there are other challenges to paying attention to that. But we're going to be using the Thinkorswim desktop software platform. The reason I say that right here is because the paper money version of the platform does not facilitate the early assignment of short options. There are other differences. Make sure that you're aware of those differences. It's not a guarantee of future success out there in the real world. But as you move your practice from paper trading to live, make sure that you recognize that there are some differences. We're going to simply be using this for demonstration purposes today. Now, investing involves risk, including a loss of principal. Regardless of how you look at the market, whether it's fundamental analysis, probability analysis, technical analysis, it doesn't matter. They are all theoretical in nature. None of those are guarantees as to how the market will perform going forward. When we talk about stop orders, and we don't oftentimes talk about stop orders in trading index options and spread trades in general, but if we do talk about stop orders, remember that there's some circumstances you have to keep in mind. Remember that stop orders only allow you to specify the activation price, not the execution price. Stop limit orders may result in the order not filling at all, so be aware of that. Now, one last note I'm going to mention, since we were talking about hedging today, is that hedging and protective strategies generally come at a cost, generally aren't expected to make money, and they don't guarantee that you're not going to lose money in the trade, but they can help to offset and mitigate some of the potential loss. So we'll be cognizant of that as we talk about some of these ideas. I wanted to jump in here really quickly, give us a quick agenda. We're going to talk about some examples. We're going to get into this pretty quick, but these are some of the strategies that we're going to talk about. We're going to talk about a calendar spread today, and we're going to talk about this idea of using index options as a means to hedge as we get into this scenario today. So let's do this. Let's switch our view over to the Thinkorswim desktop software platform, again, the paper money version. and get into this discussion. And again, thanks to all of you for being here. I love the conversations that are already going on here this morning and that you are having in this discussion. So taking a look at the SPX. SPX today off just a little bit, maybe at this little bit of a resistance level. I talked about it in a couple of webcasts yesterday, that this is a typical kind of deliberation pattern where we get the gap up, we get a rally, and those rallies start getting a little bit smaller. And today kind of it seems to be that follow through on that deliberation a little bit. The RSI rolling down from testing near the overbought level. A little bit of a down move today. I don't want to belabor this. I just want to point out this kind of shapes our market posture. We're not full on bullish, at least initially today. I mean, the market is early. I mean, we're only into the cash market today by what, hour and a half. And so kind of running off of that area, we may be bouncing here in the NASDAQ off of a resistance level, although the RSI had started to tick up into that overbought range. So maybe a little bit more bullish sentiment in the NASDAQ as some of those tech leaders come back into play, as some of the specific tariff issues that have maybe been fueling this upward rally come home to roost perhaps more acutely in some of those tech leadership names. The Russell 2000, which is primarily small caps, but a lot of technology as well, has maybe been leading here from the perspective of kind of falling off. We see that the RSI not really achieving that that overbought line, didn't get near it to touch it. I mean, it came close. It didn't get really near it. If we kind of zoom in here, we can see the beginnings of maybe what we would refer to as, if we were being poetic with our candlestick names, the evening star, right? The sunset of this short-term uptrend. Doesn't have to be, and really this could be the continuation and the extent of this rollover in these candles. Just because we have this candle and then a little bit of a gap to a deliberation candle or to an equilibrium candle and then a gap to a downside moving candle doesn't mean that this is going to be a full-on reversal. It just simply means a pause. That in and of itself maybe gives us some ideas, and that's one of the reasons why I want to look at that calendar spread, is this potential neutral-ish movement in the Russell 2000 in the last couple of days as it kind of finds this equilibrium level. Last index that I want to look at, or last grid that I want to look at here, is the VIX grid. So we've seen kind of a dramatic change in the VIX back, I mean, well below its 30-period moving average, down into the 18 handle here, which has been very, very close to kind of the overall average over the course of the last year. If we want to look at where that is, I mean, we think about where the long-term average of the VIX is, it's between 15 to 18. And so we're now kind of back in that range of where the VIX has become normalized. We're seeing a little bit of an elevation in the VIX today as we see the market kind of rolling off, and not huge, right? We're not seeing big moves into hedging positions. If we take a look at the VIX versus the VVIX, we see that the VVIX, the volatility of VIX, is getting a little bit more expensive than the VIX. That would suggest that maybe there's a little bit of buying activity going on, but that's to be expected when volatility was running a little bit cheap relative to where it was. Now maybe some buying activity going on. So that's going to maybe give us some insight again into our hedging position. So let's do this. I'm going to switch my grid over here really quickly to my index grid. And let's see, where do I have it? There we go, right there. Index options grid right there. And this is a double-sided grid. This is the one that we've been using on a pretty regular basis. The link for this grid is down in the description for this particular webcast. On the left-hand side, it's a one-year daily chart. On the right-hand side, it's just a zoom in. It's a 3-month, one-day chart. So same time frame, same aggregation. Each one of these candles is a 1 day. It's just a different view. We can see the longer-term perspective and the shorter-term perspective. This is the SPX. We've got the 200-period moving average here. And we can see that the index here, in this particular case, the SPX, has toggled above that 200 period moving average. So that was kind of our technical toggle point. And so what I want to do is I want to come back over here to, while we've got this grid up, I want to come back over here to our monitor tab. And I wanted to take a look at a couple of the areas that we have been following, specifically this one. And this is the trade that we've been trading. This is the strategy that we've been kind of examining and looking at for the last, I don't know, at least 6 months or so. And that is selling a vertical spread, either a call vertical spread or a put vertical spread, at 14 days to go until expiration, and then buying it back at 7 days to go until expiration. And the primary reason for this, and I've explained this a couple of times, and we've talked through this, the primary reason for the 14-7 trade-off and not holding these through till expiration, but the kind of thought process here is taking advantage of counter trend movement, right? So we're kind of playing the contrarian here. We're selling against the direction that the market is moving, and we're taking advantage of the relative kind of accelerated nature of time decay. If this is our theta curve, this is price, and this is time to go until expiration, right? So an out of the money option, and we've been selling far out of the money spreads. That out of the money option, the time decay curve kind of accelerates, at least at the initial end. It inverts from what we're normally used to seeing. The normal time decay curve that we're used to kind of seeing over time is this kind of logarithmic shape, which works well for the at the money strike, or close to the at the money strike. When we are selling a vertical spread, you know, at a 17 delta or a 15 delta, or one standard deviation away from the where the price the index is, then we're kind of in that out of the money position. And so this is the curve that we normally get for an OTM or deep ITM, deep in the money strike. It tends to kind of invert a little bit. And the convexity of this is what we're trying to take advantage of. So the reason we're going 14-7 is we're trying to capture, let me change my color here so that we can see this. We're trying to capture this time frame right here, right? This acceleration of that time decay by selling at this point and then buying it back here, right? Buying it back somewhere in this range. So we're going to sell there and we're going to buy it back there. That is the idea. And again, this is the reason why we've been talking about it the way that we've been talking about it and the way that we're looking at this. Now, I said at the very beginning as we were discussing this, and for those of you that have just been joining us, we are glad to have you here. And this is why I'm talking through this a little bit so that you have some context to this discussion. But what we've been doing is selling it at 14 days to go until expiration and buying it back at 7, come what may, regardless if it's a win or a loss, simply to illustrate that sometimes you can take a win, sometimes you can take a loss. And we've taken a couple of big losses, including potentially what is going to happen right now. So we sold this vertical spread for $490. It's now trading at 29. It's a 50-point wide vertical spread, right? We're at the 58.50 call and the 5900 call. So it's a 50-point wide vertical spread, and it's trading for about half of its width. We brought in the $4.90, so we're going to realize not max theoretical loss in this particular trade, but we're going to realize a pretty hefty loss in this particular case, right? So Journey says, yeah, I get that. So selling time decay works for you, huh? Well, not in this case. And this, I'm glad you brought that up. Journey, I 100% own that, 100%. The reason that this particular circumstance is happening is because while theta, the option Greek theta, time decay, is inevitable, and in fact is the only inevitable of the option Greeks that we have, right? Barring certain existential crises, right? For the most part, we know that the sun will come out tomorrow. But what we have to recognize is that the big driver of any option trade, the biggest driver in most cases, the biggest driver is this delta in the driver's seat, right? Delta. No, it generally does. And I know you were not being flippant about that, Journey. I appreciate your comment. I really do. But delta is in the driver's seat. Delta is always the bigger of the influences, even if we're at the out of the money position or if we're in the money position, because we know that if we're in the money, it's a much bigger driver. If we're way out of the money, it's still a pretty big driver. There is a point where we kind of come to that crossover between, especially as we get close to expiration, between delta, a small delta, and increasing things like gamma, right? But delta and then theta and then vega. I'm not going to do the option Greeks, the Greek letters there, because I can do them, but my lettering is bad enough. But those are kind of the priorities, right? Delta, theta, vega. And as we get closer to expiration, then gamma becomes a bigger influence. I'll just put gamma here as a G, right? So gamma becomes a bigger influence. But, and Mighty Mouse says, I cut the loss short. Yeah, we could do that, certainly do that and not take a loss, right? But I wanted to do this and leave this, and I think this is a good example of kind of seeing that priority in action. Delta is in the driver's seat when it comes to these trades because the market moved. If we go back to the chart, right? Let's go back over here to our chart. And the reason that I put this up here is when we put this trade on, it was last Wednesday. So that was like right back here. And we were seeing this move still with that potential to go higher, but we were still below the 200 period moving average, right? So we were still in that toggle to the point where we were selling call spreads contra to the trend because we were below the 200 period moving average. That's the rule in this case, in this scenario. If the index is below the 200 period moving average, we're selling call spreads. If it's above the 200 period moving average, we're selling put spreads. And then we saw that big move to the upside. And that drove delta as the biggest driver here. And that's why we're in the position of taking a loss, right? And Brown Buffalo, VIX was much higher than, but it was a short vertical spread. And so that benefited us, that fall in the VIX, because the VIX collapsed. But at the same time, again, delta overwhelmed that, right? So let's kind of take a look at this. Let's go back to our monitor tab for a second, and let's first of all close this down and realize this potential loss in this particular case, right? Yeah, and Ricebird, you're right. The loss was due to expecting the SPX to continue to stay sideways and not move in a positive direction. But we recognize the fact that volatility was higher suggests that there was greater potential for movement in the trade. So what I'm going to do is I'm going to create a closing order, and we're going to buy this one back. And I'm just going to read through this order, make sure that this is what I want to do. I want to buy it back. We're realizing not the full theoretical loss of that 50-point wide spread minus the $4.80 of credit that we brought in, but we're realizing about, maybe a little more than half the potential maximum loss in this trade. And we're going to click on send, and we're going to fire that order off, and we're going to buy it back. Now we've cleared the board, right? Mighty Mouse, you could, right? But, and Alex, we'll talk about that as we get into this discussion in terms of potential movement. So now let's do this. Let's go back over here to the chart, because the chart is what we've been using as kind of our measurement of where we're going to put this spread. You can see I made a hash mark. I'm going to zoom in over on this right-hand side. I made a hash mark right here. That hash mark that I made, that little line right here, was the one standard deviation line. It was the outside edge of this probability of expiring cone 7 days ago. And so you can see the move that this index has made to the upside in that time frame. So we're going to do the same thing, but our rules have our ideas here, our considerations have flipped the toggle between bullish and bearish, right? Now the index is above the 200 period moving average. So now we're going to sell a put spread. So where this idea suffers, and I'm realizing this, where this idea suffers is in the transition. When it's near that 200 period moving average and when it's about to toggle, we can take a big loss. So that's something that if we're developing this as a robust trading strategy going forward, that a trader might have to mitigate is in this time frame and maybe put some sort of oscillation filter, especially when it is near that 200 period moving average, either above or below. Put some kind of oscillating filter on there, maybe the MACD, maybe an RSI, to maybe qualify taking a trade during that transition. When it's in a trend, probably makes a little more sense to simply follow this perspective. But that's kind of the way that a robust trading system is developed. So what we're going to do is I'm going to go to the trade tab, and I know that 14 days out from now is going to be the 28 May expiration on the SPX. And I know that with implied volatility where it is, this implies a plus or minus move for where the price of the stock is, or the price of the index is right now, which is 58.88, plus or minus about $153, right? So that implied move is where this idea comes from, this market maker move up here. That market maker move flag, that those yellow numbers and that plus or minus occurs anytime that there is a disparity between the front or the closest expiration and the next available expiration. So what this is suggesting is that because there's this volatility disparity, right? The volatility in the current expiration today is higher than the volatility for tomorrow's expiration. This is the implied move in that time frame. So over that 1 day time frame, there's an expected move of about 16 points, plus or minus. That's the market maker move that's imparted by that disparity or dispersion between implied volatilities across the two closest expirations. That can be useful, especially around something like an earnings announcement. It becomes perhaps maybe a little bit less useful unless you're trading zero DTE strategies in looking at these index options, because we oftentimes will have in these index options daily expirations, which is nice and convenient, but it also makes it maybe a little bit less, unless you are trading some of those strategies, a little less effective. All right, let's go to the charts now. We know that our 28 May expiration is our 14-day time frame. So I'm going to put my time hack. I'm going to grab on my drawing tools here, the time slice, which is the vertical line, and I'm going to go out to 528. And we're going to put that vertical line here in place. So we know that that's where our 1 standard deviation level is. So I'm going to grab my drawing tool again. We're going to draw the intersecting hash mark here at the 6105. And I'm probably going to say it's probably closer to 6100, just from practical terms in terms of our strike prices. I don't know if we have a 6105 strike on the index, but we might. So I'm going to draw that hash mark right there. That's my 14-day hash mark in this particular case. So Mighty Mouse is saying this, but the market's too bullish. Yeah, okay. Wait a second. Thank you, Mighty Mouse, for reminding me, because we're now flipping down to the other side, right? So there's the upside. But remember, we're above the 200 period moving average in this case. So I got to come down here because we're going to sell a put spread. Gosh, I almost did it wrong, or almost did it the other way. I mean, again, this is the reason why we say, read the order twice and then trade once, or so that you don't do what I do typically on a Saturday. And John, I know, will laugh at this, because I know John's probably done this too, but it's you measure once, you cut twice, and then you go back to Home Depot and you get another board because you screwed it up. So I'm going to put my hash mark right here at the 5,700 strike right down here. That's about the 5,700 strike. Now let's go over to the trade tab. And let's go to our May 28th expiration. This is 14 days out. And we're looking for the 5,700 put. We only have 30 strikes, so we got to add a bunch of strikes here. I'm going to add 100 strikes to this. And there's our 5,700 put right there. 5,700 put is at about the 16-cent delta. So what I'm going to do is I'm going to go, and this is where we've been going 20 points wide. We had to go 50 because that's all we had. So I'm going to go to the 5,700, 56.80 spread. And we're going to sell the 5,700 and we're going to buy the 56.80. So we're making a 20-point wide vertical spread. Yeah, cut it twice and it's still too short. We need the board stretcher at that point. So 5,700, 56.80, 20-point wide vertical spread. We're bringing in $2.10 in credit. Click on confirm and send and we read through this. So our max theoretical loss, if this plows us over. So what this would mean is we'd have to make almost a 2 standard deviation move to the downside, because this is the toggle point where we switched over to the other side. This would have to make a 2 standard deviation move to the downside in this particular case. So from where it is now, up near the top of that range, back down, and here we are at theoretical small max profit. Again, this isn't a home run trade. This is simply designed to continue to generate income over time. And we're going to sell this and we're going to put it in our index options weekly group. And we're going to look at taking this off next Wednesday, come what may. And so we're going to read through the order, make sure that we're aware of that, transaction costs, and any alerts that we need to pay attention to. And we're going to fire that order off. We sold it for 210. Now it's sitting out there. We're going to hopefully take advantage of that accelerated rate of time decay in that front week, right? Yeah, and Harry, if you want to trade those longer term and see how that works, absolutely, right? For sure. And so I want to do this and continue to do this for illustration, for illustrative purposes. All right. Now, the second thing that I want to do in this discussion is I wanted to go back to that chart and I wanted to go over here to the Russell 2000, RUT, because this was a question that somebody asked me in the comments section, and I told them I would talk about this today, and that was the idea of not being able to do a 0 DTE. We did a 0 DTE calendar spread on the SPX, but they weren't able to do a 0 DTE on the Russell 2000. Remember, a calendar spread is selling an option closer to expiration and then buying the same strike further away from expiration. The intent is to capture neutral movement and take advantage of that potential dispersion between volatility in the front month and the back month, or the front expiration and the back expiration. The reason that we might use a 0 DTE is to take advantage of event-driven neutrality, right? Or this lack of movement. That's kind of where we are here on the Russell. And to potentially capture rapid time decay. Same reason we're doing that vertical spread 14.7. We're using a calendar to kind of replicate that as well. So we're just doing it with 2 less strikes. So here's what we're going to do in this particular case. I'm going to look at, on the Russell 2000, we're going to go to the trade tab. I'm going to look at where this index is right now. And it's sitting right about the 2089 mark on the Russell 2000. Again, remember, these are European style indexes, which means that the options cannot be exercised until expiration. So we take out early assignment risk in creating these trades. However, one of the challenges is in initiating a trade close to expiration is that the broker, and this is a brokerage decision and a brokerage determination, the brokerage may either decide not to allow the trade to be initiated, number one, or number two, may take the trade off if there is potential volatility, if there is the likelihood that that trade could result in adverse pricing. Now, that just simply means that the margin desk is aware of and pays attention to directional and volatility risk, especially as a trade gets close to expiration. Now, you can make the argument, look, any trade, if it's held to expiration, becomes a 0 DTE trade. So what I'm actually going to do in this particular trade to avoid that scenario of maybe not allowing the trade to be initiated in that 0 DT, specifically in 0 DTE, meaning we're putting on the trade today and it's going to expire or be closed today and done because that's all it has left to trade, is we're going to put this on at 1 DTE instead of 0 DTE. Yeah, the trade, that 0 DTE trade that we made last week, in fact, we did. It went out because we saw a pretty quick collapse. It went out quickly, and we actually ended up making money on the trade. And in that example, remember, these are all illustrative and educational examples. So this is what I want to kind of replicate here in talking about these ideas. So if we come back over here to the Russell 2000, what we're going to look at, and this is, again, one of the potential benefits of trading index options that have multiple expirations, is that I have a 1 DTE and I have other expirations that I can choose from. So we're actually going to do not a 0 DTE because of that challenge of potentially putting the trade on and having the margin desk say, or having the margin desk say, nope, we're going to take that trade off. That is concern, right? And that is something to be aware of. But let's put the trade on as a 1 DTE, and we'll go at 1 DTE and say, for instance, let's go to where there's a lack of volatility back here in this back expiration. Let's go 13 DTE. So what we're going to do, and that gives us a number of opportunities to roll this particular trade. But my expectation is that this index is probably going to stay somewhere right here about this 2085 level. So I'm going to go to the trade tab and I'm going to go to 1 DTE. This is the 1 day till expiration time frame. And again, we don't need 100 strikes here because we're dealing with close to the at the money strike. So I'm going to go to the 2085. And the spread's not huge, but it's not narrow necessarily either. So we might look at something that is maybe a little more liquid, but at the same time, I wanted to illustrate this on the Russell 2000. But I'm going to go to the 2085 strike, and I'm going to sell the 2085 strike with 1 day to go until expiration. And then at the same time, before I fire the order off, I'm going to come out here to this 13 DTE time frame, and we're going to go to the 2085, and we're going to buy the 2085 strike. So now what we're doing is we're creating a 1 DTE, 13 DTE calendar spread. The idea being, at the same strike, this is going to benefit from time decay. It's going to benefit from implied volatility rising in the back month and really kind of falling, the expectation that all that time decay, all that extrinsic value is going to come out of the front month, or the front expiration. So I'm going to send this to the Analyze tab so that we can look at it really quickly here. And here's what this looks like. In order for this to get the max theoretical gain, right, it's got to be right here. It's got to be right at that peak at expiration. Let's float this strike. So that's at the 2085 strike. So let's make this the 2085 strike, right? That's where this price has to be of this index tomorrow at expiration in order for this to get the max theoretical gain. So this has a pretty big loss and a small range of potential gain. So it might not be in terms of risk to reward, might not be the best risk to reward. But in this particular case, the idea is we're going to capture some of that and hopefully maybe go out at that level and then roll, because we've now got 3 or 4 more days of rolling opportunities that we could continue this trade. But one of the things you notice is if we look at our delta or option Greeks here, this trade right now, as we put it, if we put it on, is relatively delta neutral. It's got a net delta of about 0.1, right? So this is a relatively delta neutral trade. Remember, these numbers are times 100. It has a very low gamma impact, and it won't see an increase in gamma until we get to tomorrow. But even still, gamma on indexes, because of that lack of early assignment potential, the gamma tends to be, even into expiration, relatively low relative to single stock options. But look at this theta rate. Man, that theta burn is pretty significant in terms of that time, because we know by the end of tomorrow, all of the value, all of the extrinsic value of that 2085 put that we sold is going to be gone. So it has to burn away quickly. So we're taking advantage of the inevitable quick decline of that extrinsic. So at expiration tomorrow, that option is going to be either worth intrinsic or zero, right? Period, end of story. Vega sensitivity is pretty high, relatively high in this particular case. So if implied volatility does rise, that's going to benefit, because it's going to benefit the back leg, the one that expires on the 27th of May, more than it's going to hurt the one that expires on the 15th of May. So I'll tell you what, I mean, now we're getting deep into this, but I don't want to get too far down this road, but I want to put this trade on just so that we see that. So our primary influences here, delta is not necessarily in the driver's seat here in this calendar spread. We've taken delta out of the equation because we've made it a relatively delta neutral trade. We've put theta in the driver's seat here in this particular case. So that becomes the primary influence, and theta is the inevitable. That's what a calendar spread does, for sure. Okay, so let's do this. Let's come back and let me take my annotations off here, and let's put this back here, and let's come back down to our trade entry button, and we're going to put this trade on. I'm going to float that so that we're right at 17. Click on confirm and send. Here's the thing. We don't know what the break even or the max theoretical gain is on the trade, because this doesn't account for potential rolls. So we know what our impact is. We know that what our buying power impact is. So we're going to put this on, and we're going to see how this works. And we're going to manage this over the next little while. We've got about 14 days. So we've got 2 weeks at least that we can manage this. So I'm going to put this in our index options group. We'll see how this goes. But I wanted to do this again, not as a 0 DTE, but as a 1 DTE calendar spread. And you can do it either way. But I wanted to just be aware of that particular circumstance from the broker perspective, right? All right, now there's that. Now, last thing I want to do here really quickly is I want to come back over here to my monitor tab. And this is something that we've been doing on a regular basis. This stock portfolio that I have in my demonstration account is relatively broad based. I mean, it's pretty good cross section of a variety of industries. A lot of them are small caps. I can look at the market capitalization here, and I can sort this list by market cap. I've got a number of small caps in this particular group. So what that means is it's probably pretty sensitive to the small cap index, right? So I beta weighted this stock portfolio to that small cap index. And I beta weighted it to the Russell 2000, which we were just looking at. And because I beta weighted it to the Russell 2000, we used the Russell 2000 and we bought Russell 2000 puts against this. So our total sensitivity with those puts in place is 146 deltas. It's still pretty directionally sensitive to the Russell 2000, but we've reduced about 100 of those deltas by buying those puts. And the puts have appreciated in value. We open up those puts and we can see that we bought them for 20 bucks. They're now trading for $23.80 or so. So they've appreciated in value. But the question is, when might we take the hedge off? Right? When might we take the hedge off? So I found a resource. And if you were with me yesterday in my futures webcast, we talked about this, but I wanted to show you where I found this. So I went into my Schwab.com page. I went to the Learn tab, and I actually went into the information that's over here on the left-hand side under what's called Insights and Education. And where I found this particular area was in futures, but let me explain for just a second. If you go to, say, for instance, options, and you go down this list, there's some great information here. You see also some of the webcasts. You see some of the links to our webcasts for some of these strategies. But then you've got these courses that are very helpful if you want to kind of reinforce some of these ideas. And what I went to is this one right here, non-directional options, advanced spread. So this also covers things like calendar spreads. So for those of you who kind of maybe got lost in what we were talking about today in terms of that calendar spread, this is a great way to reinforce that. We've got a lot of opportunities to kind of look through those strategies. But there's this non-directional options advanced spread sample investing plan right there. And that sample investing plan kind of takes you through some of those characteristics, right? So this is a calendar spread sample investing plan. Again, this is for illustrative and educational purposes only. And you can download this to do this. Now, the catch is you got to be logged into the schwab.com website, right? So, by the way, if you don't have that account, if you don't have a schwab.com account, you're here with us, we're glad to have you. Get in touch with one of the branches, one of the local branches, and we can take care of that. They can take care of that for sure. So what I did is I actually went back a step here, and I went to the Learn tab, and I went to futures. Now, I'm not talking about trading futures. Remember that futures trading involves significant risk. It is not suitable for all investors. If you're going to trade futures, make sure that you're aware of the considerations, and remember that it takes separate trading authorization. I'm just using this as an illustration of where I found this information. And I went to the course called Fundamentals of Future Trading, and I found this investing plan. And this investing plan specifically focuses on hedging. And so it says, when do you take a hedge off, right? When do you exit a hedge? It's not specific to futures. It says, when do you take a hedge off? After an announcement or event, after the market discounts the news, and the technical signal that you might use is a bullish 200-day moving average or a major index breaks resistance. Okay, those are the kind of considerations for when do you take a hedge off of a particular portfolio. So I go back to the portfolio, and I say, all right, I've got a portfolio that's beta weighted to the Russell 2000. Let's look at the Russell 2000. Has it broken above the 200-period moving average? No. Has it broken a major level of resistance? No. Have we had a news announcement, and has the market digested that? I would argue yes, in this particular case. We had the news last week that caused the market to move higher, but it hasn't done two of the technical things that we might look for taking the hedge off. So it's not broken a resistance level, and it's not broken up through the 200-period moving average. So we go back to the monitor tab and we say, is it time to take this Russell 2000 hedge off of this portfolio? Not yet. Not yet. So not taking the hedge off yet. We're going to leave that in place until that Russell turns more bullish. Now, if we were hedging to the SPX, if we were hedging to the NASDAQ, might be time to take that hedge off. But since this has more sensitivity to the Russell 2000, and that's what we beta weighted it to, we're not taking the hedge off in this particular case. But we're using these put options, and these put options are still making money. That money that we're bringing in is the offset to, and the delta reduction is the offset to the potential adverse movement of the portfolio as a whole. So that hopefully gives you some insight into, yeah, and there you go, Brown Buffalo, put an alert on the 200-period moving average. As it breaks above that 200-period moving average, it's broken above the resistance level, and that might be the trigger then to take the hedge off in this particular position. Boy, guys, I know we got pretty deep into a lot of stuff today, but what I wanted to do too is give you some ideas. One, if you want to learn a little bit more, you want to join us in person, we're going to be in Anaheim in a couple of weeks. We're going to be in Santa Clara in about a month or so, a little over a month, in Santa Clara doing the Technical Analysis and Option Strategies workshop. We're going to be in Florida and New York doing our Market Drive event. So come and join us. This is in the schwab.com/coaching in-person events page. And the other thing is, if you want to learn more about these ideas like beta weighting, just come here to the webcast page, and you can learn a lot about beta weighting. Brent Morris talks a lot about it. I know John's talked about it. I've talked about it. But this is also a good place to click on subscribe, as is down at the bottom of the page right here. Click on that subscribe button. Join us here in the Trader Talks webcast page. You guys are smart YouTubers. You know this stuff, and we appreciate that. We've got a lot on the East Coast. We're going to be in D.C., in September, we're going to be in New York twice. We're going to be in Miami twice. That's kind of on the East Coast. It's on the East Coast of Florida. But some great research here and great stuff that you can follow. Also, follow us on X at Ben Watson CS. You can follow John at John McNichol CS. We're out there in the social media space as well. Thank you for being here. My thanks to John McNichol for helping out. My thanks to Andrew and our great production staff for bringing us to this stuff to us. And we will see you guys again very soon. Take care, everybody. Bye-bye.